Will this be the end of the tech boom? There's been a lot of buzz lately about whether we've reached the peak of the tech boom. A tech correction could be looming, and everyone seems to have an opinion. Analysts, media outlets, investors alike. But are they right? Is the tech boom really over? Or are we seeing a temporary blip in the market? Last week, the tech-heavy NASDAQ took a significant hit, and naturally the media went wild. Forbes published multiple articles on it, CNBC covered it extensively, and it was all over financial news platforms like Bloomberg and Seeking Alpha. The focus? Well, tech stocks were down, and many were quick to declare that the boom we've been enjoying for over a decade might finally be coming to an end. But let's take a step back and look at the data. What's really happening in the world of tech, and why is the market so volatile? Is the hype around tech stocks starting to fade, or is this just another cycle of ups and downs? In this video, we're going to dive into the numbers, the big players, and what might really be causing the turbulence in the market. First, let's talk about what's been driving the tech boom in recent years. If you look at the S&P 500, you'll notice something striking. A massive portion of the index's growth is driven by just 7 companies: Apple, Microsoft, Amazon, Google, Alphabet, Meta, NVIDIA, and Tesla. Now, these companies often referred to as the Magnificent Seven. They're essentially the face of the tech industry today. Over the past decade, these businesses have posted astronomical gains. Take Apple, for instance. Its stock price has climbed by more than 700% since 2013. NVIDIA has seen an even more dramatic rise, with its stock soaring by over 2,000% in the same period. Now, these companies have been riding the wave of technological innovation from cloud computing to AI, and investors have poured billions into them, expecting the good times to keep on rolling. But here's where things get interesting. Despite their massive growth, these companies are now facing increased scrutiny. As of mid-2023, the Magnificent Seven made up about 30% of the entire S&P 500. Just think about that for a second. Just 7 companies out of 500 control nearly a third of the index's weight. This level of concentration is absolutely unprecedented, and it means that any shift in investor sentiment toward these companies can have an outsized impact on the broader market. Now, let's move on to tech valuations. Are we in bubble territory? Well, a lot of the current volatility comes down to one key issue: valuations. Tech stocks have been bid up so high they're now priced for perfection. Investors are expecting flawless execution from these companies, and any minor slip-up can result in a sharp decline in stock price. Let's take a look at some numbers. NVIDIA, for instance, has a price-to-earnings or PE ratio of around 80. That's extremely high compared to the broader market. To put that into perspective, the S&P 500's average PE ratio is closer to 20. This means investors are paying a premium for NVIDIA's future growth, but that also leaves little room for error. If NVIDIA fails to meet expectations in any given quarter, its stock could take a significant hit. Tesla is another great example. After its latest earnings report, the stock dropped by 12% despite the company beating revenue estimates. Why? Because Tesla missed on earnings per share, EPS, and in a market where investors expect nothing short of perfection, that's enough to cause a sell-off. Even with the recent drop, Tesla's PE ratio sits at around 56, which is still quite high by historical standards. Now, the same can be said for other tech giants like Apple, Google, and Meta. These companies have been growing steadily, but their stock prices have been propped up by investor enthusiasm for future growth, particularly in areas like artificial intelligence, the metaverse, and autonomous vehicles. However, as growth slows and competition heats up, investors are becoming increasingly skittish. Let's talk about AI, because it's a huge part of why these tech companies have been able to maintain their sky-high valuations. The rise of artificial intelligence has created enormous excitement in the market, with investors flocking to companies that are perceived to be at the forefront of this revolution. NVIDIA, in particular, has benefited from this, as it's seen as a leader in the AI space due to its dominance in the GPU market, which is absolutely, of course, essential for AI computing. But here's the thing. AI is still in its very early stages, and while it holds immense potential, it's also a very long-term play. Investors are essentially betting that these companies will continue to lead the AI race and that their earnings will eventually catch up to their valuations. However, if AI doesn't deliver as quickly as expected, or if new competitors emerge, we could see a significant reevaluation of these stocks. Take a look at Alphabet or Google, which has been investing heavily in AI through its DeepMind division and other projects. Now, Google's stock has been highly volatile in recent months, with investors reacting to every new development in the AI space. After posting solid earnings, Google's stock still dropped by 5% because of a minor miss in revenue for YouTube. This shows just how much pressure these companies are under to perform perfectly. So, are we on the brink of a correction? If you look at the broader market, there are definitely signs that a pullback for the tech sector could be on the horizon. The Magnificent Seven have seen incredible growth, but with such high valuations and increasing competition, it's possible we'll see a cooling off period in the tech sector. Let's not forget that we've seen this kind of thing before. Remember the dot-com bubble of the late 1990s? Back then, tech stocks were bid up to unsustainable levels, and when the bubble finally burst, many companies saw their stock prices plummet by more than 80%. While today's tech giants are much more established and profitable than the companies of the dot-com era, the lesson remains the same. Valuations matter, and when stocks are priced for perfection, there's a lot of risk involved. But that doesn't mean the end of the tech boom altogether. It's important to remember that technology is still driving innovation in many industries, from healthcare to finance. The companies that can continue to innovate and stay ahead of the competition will likely emerge stronger in the long run, even if we see some short-term volatility. Now, one of the most important factors driving the current market volatility is investor sentiment. As we've seen, the Magnificent Seven control a huge portion of the S&P 500, and their stock prices are heavily influenced by how investors feel about their future prospects. When investors are optimistic, these stocks soar. But when there's uncertainty, whether it's due to macroeconomic factors like inflation, interest rates, or geopolitical tensions, these stocks can fall just as quickly. For example, Apple recently faced a 5% drop after news that Warren Buffett had sold a significant portion of his shares in the company. While Buffett's sale was likely part of a broader strategy to rebalance his portfolio, that news sent shockwaves through the market, leading many investors to question whether Apple's growth prospects were as strong as they once believed. At the end of the day, the future of the tech sector will depend on a combination of factors. If companies like Apple, Google, and NVIDIA can continue to innovate and grow their revenues, they will likely maintain their leadership positions. However, if growth slows or new competitors emerge, we could see a reevaluation of the entire sector. In the short term, expect more volatility. The tech sector is inherently cyclical. We're currently in a period of heightened uncertainty. However, long-term investors who believe in the power of technology to transform industries will likely continue to see opportunities in this space. So, is this the end of the tech boom? Not necessarily, but we could be entering a new phase where only the strongest companies survive, and investors need to be more selective about where they put their money. Stay tuned, because the tech sector is bound to be one of the most exciting and unpredictable places to be in the years to come. Thank you very much for watching, and please subscribe to us here at Epic Economist.